How to become a millionaire in Canada in 20 years starting from scratch. Imagine looking back 20 years from now and realizing you actually became a millionaire. Not through luck, inheritance, or working yourself into burnout, but through intentional, smart investing. Today, I'll show you how Canadians can reach $1 million in 20 years using passive, reliable strategy. No Bitcoin, no real estate, just simple investment options that actually work. We'll break it down into three plans: conservative, balanced, and aggressive, each with numbers, real examples, and options tailored to young professionals across Canada. Let's get into it. So let's start first with the conservative investor. This is more of a low risk approach where you value safety first. If you're the type of person who loses sleep over risk, the conservative path is for you. We're talking high interest savings, GICs, government bonds, and stable dividend paying stocks. The goal: preserve your capital and earn a consistent return of 3 to 4% annually. Again, this path is for those who want certainty over speed. You prefer stable, low risk assets, even if returns are modest. A conservative portfolio leans on secure, government backed, or blue chip assets. Expect modest returns in the 3 to 5% per year, but rock solid peace of mind. Income earned on bonds and GICs and in high interest savings account is fully taxable. Dividends paid from dividend stocks are a little bit more tax efficient, but are still taxed. So you may want to consider investing in these within a TFSA or RSP to shelter taxes. With compounding, reaching $1 million in 20 years at 4% requires large savings, roughly $2,731 per month. Let's take Vanessa, for example, a 30-year-old librarian in Halifax. She funnels $1,365 every 2 weeks into a laddered GIC strategy inside her TFSA. By age 50, she'll quietly cross the $1 million mark with minimal volatility along the way. To help take control of your finances, consider picking up my book, Rich Life Rising, on Amazon.ca. Next, we turn to the medium risk investor, balanced growth. Growth plus stability is the key here. Let's say you're comfortable with some market ups and downs. A balanced strategy for moderate, steady growth. So you're okay with market swings, but want a diversified, dependable plan. This strategy essentially blends equities or stocks and fixed income or bonds for smoother growth. It mixes stocks and bonds with an eye on growth plus income. Think approximately 60% equities, 40% fixed income, give or take 10% in each bucket. Expected returns could be roughly 5 to 7% per year. Core elements can include index funds and ETFs, a Canadian all-equity fund and a US S&P 500 fund capture broad markets, for example. Historically, US stocks have averaged about 10% and Canadian stocks about 9%, so a blend might realize in around the 7 to 8% in a good decade. Meanwhile, a bond ETF like BMO Long Federal Bond adds stability. A simple 60-40 mix of TSX US equities and bonds has historically returned approximately 6 to 7%. Also, dividend and sector ETFs could be a consideration. Include Canadian dividend ETFs, which yield approximately 3% and grow modestly, and sector funds, example IXG for Canadian financials. They tilt your portfolio toward income, but with some equity growth. REITs, which are real estate investment trusts, provide real estate exposure. A diversified Canadian REIT ETF has averaged a little over 8% annual returns, including dividends over the last decade. And add that in, and you boost overall yield. With these ingredients, a balanced portfolio might net around 5 to 7% annually. So, for illustration, we'll use 6%. By doing that, we'll need roughly $2,172 per month to hit $1 million in 20 years. Example, the Canadian tools that you could use is to buy these in a TFSA or RRSP to minimize the tax using platforms such as Wealthsimple or RBC Direct, using a dividend reinvestment plan to turbocharge compounding. Incidentally, I talk about TFSA dividend investing strategy in one of my other videos, so be sure to check that out. The takeaway here for this moderate risk profile is that it balances growth with some safety. Returns around 6 to 7% let you reach that $1 million in about 20 years with contributions just over $2,000 per month. You can afford some market dips, and the stock REIT growth can significantly amplify wealth. It's a popular sweet spot, safer than an all equity or all stock portfolio, but more growth oriented than cash or bonds only. Let's take Daniel, a 35-year-old software developer in Toronto. He automates $2,172 per month into a couple of different Canadian balanced growth ETFs inside his TFSA and RRSP. He never tries to time the market, yet he'll still hit $1 million on schedule. Next, we move to the aggressive investor, high risk, high growth. For the bold investor, if you're looking for the 8 to 10% returns or higher and can stomach the volatility, this path could get you to $1 million faster and with less of a monthly investment. Think high growth tech stocks or ETFs. Focus on fast growing sectors like NASDAQ 100, the triple Qs, or individual tech darlings such as Shopify, which is a Canadian company incidentally, Amazon, or Apple. Now, the NASDAQ 100 index saw a negative 33% return in 2022. And then in 2023, it saw plus 53%. So we're talking huge swings here. Even at the 10% annual return S&P level, you need big contributions. In short, tech can supercharge returns, but expect roller coaster volatility. 80% stocks and 20% bonds would still be considered an aggressive mix. But remember the volatility. A couple of bad years, like between 2000 and 2002 for the dot-com bubble, or the financial crisis of 2008, could leave you underwater, especially if you panic sell. To reach $1 million in 20 years for this aggressive investor, assuming an 8% annual return, would require a moderate to big savings and investment. You would need per month $1,709 invested every single month for 20 years to reach that $1 million. This is definitely the faster lane if everything goes right, but it can also fail. Make sure you can handle losses, but if you stick with it, higher returns mean smaller monthly needs when compared to a conservative or balanced investor. But you're far from guaranteed results. Remember, past performance is not necessarily indicative of future performance. This path has the most upside, but also the biggest chance of loss and volatility. Only go this route if you can handle the big swings and are in it for the long game.